approximately 20% of the millionaires in India are under the age of 40. And you've spent nearly 30 years of your life inside the financial lives of the wealthiest people in the country. Tell me, up close and personal, what does it really look like? And does that stat really come by surprise?
No, it's no surprise. Looking at how the numbers are stacking up today and the way India is moving as an economy, I think it doesn't come as a surprise. In fact, we'll be surprised to see if the numbers go down. It's only going to go northwards from here. Okay. So yeah, rightly said, Avan, we have a lot of millionaires and billionaires carrying under the 40 and the 40 and the 40, right? People are making money. You've seen explosion happening in the tech sector, the AI sector. A lot of people have created absurd valuations, right? So they've seen crazy wealth overnight. And it doesn't come as a surprise. I'm sure India has much more to give from here. And you go to see the numbers start swelling up more and more as we move forward. Yeah, but the whole idea and the whole experience is, how do you manage temperaments of such people, right? I mean, I have seen people with generational wealth. I've seen people with new money. The whole idea is, when you sit with these two different sections of people, I think to each, how do they look at money and their relationship with money is very different, right? While the people who are wealthy, who are born into wealth or who've created wealth in their lifetime over 3, 4 decades, 5 decades, right? For them, I think it's the risk-taking ability is slightly lower. For them, it's more of capital preservation. They believe that I have not heard any large family telling me, Deepak, how would I make a 20, 30, 40% returns on my capital invested? They say, you give me a 12% upwards. I'm pretty happy with that. Okay, so I think it's more about preserving your capital, creating a legacy to be the legacy that the wealth can be passed on to the next generation. And they're happy with you're beating inflation, you're creating a number of 12% upwards. They're pretty happy with that, because once you touch a 15% number, the wealth compounds at every 5 years, it doubles up, right? Any which ways. And markets have done that. But if I look at the new generation of wealth creators, I think their risk-taking ability is way higher. Okay, they have seen exponential wealth, and they're open to taking more risk in their portfolios. Okay, they're ready to back more startups because they've seen the valuation game unfold in a very different way than we've seen. So their ability to take risk is very, very high. And the beauty is when you have these two generations, completely different thought processes of two generations coming together and sitting on one table. That's more exciting.
So you're saying that the people who have built wealth at a later stage in their lives, like a lot of the tech entrepreneurs, for example, they are more risky by nature in terms of
their appetite for risk is way higher. Because they have made money, they have seen quick money. Also what happens, Avan, it works both ways. They have seen maybe one cycle of wealth, right? I mean, if you see the last 5-6 years, there has been money made. Maybe people have seen one cycle of the markets. Looking at portfolios delivering in excess of 30-40% in the last couple of years. Of course, 2 years, the markets have not really done well. It's kind of, it stayed muted. But when you see only one bull cycle, I think what we as advisors or as wealth managers need to tell them is to be more patient, is to change their temperament, is to instill a bit of discipline and patience into them, because they will see more cycles like this coming in. We will, because people who've seen cycles in last 30-40 years have seen cycles of 2008, have seen bear cycles. They exactly know, when the markets are beaten down, when the portfolios are bleeding in red, okay, and how to deploy more capital back then. So you need hard to deploy capital, because when your valuations are very, very down and cheap, the markets will come up sometime, and they don't give time to react. They don't give time to understand.
But I mean, with that kind of wealth that they have and the wealth that they have created, is there still at the time of a market crash lots of questions, or are they just like, do what you want, I trust you, or this is the time to invest, I've been through this before? Is the mindset different from that of an average investor?
So definitely, Aman, like I always say that, wealthy clients always have cash and liquidity in the portfolio. Cash is king, I always say that. So they always keep 10% cash in the portfolio, and that is primarily kept for taking advantage of, markets when markets are beaten down, when the markets are going through a turmoil. That's when the time they start deploying money at various stages of the market, because they see long term. They understand that markets will come back and come back in a very big way. Okay.
Yeah.
So the idea is to keep deploying. I think our job is to when you're matured investor, there are two investors. One is the matured investor who's seen cycles, who understands that. One is a new investor. He says, what next? Should I take money out of the market whilst my portfolio is down, or should I stay invested? I think it's a trust that you build in with them. And then when they trust you, then you take calls, you move first, the money's in liquid, because the way the markets are moving today, you don't know at what entry. I mean, you're seeing the markets being on a yo-yo form, right? So in a staggered way, you move money in the markets. And I think equities is the thing to be in for the next 10, 20 years. The money the markets will make for clients is going to be very, very different from here. So I think we are in a golden phase of markets. I'm not saying today. Now, of course, now the markets are looking very edgy. They've been edgy. But yeah, I think it's a great time to keep entering looking at a long-term perspective. Definitely, yes.
So tell me what an average portfolio of an Ultra HNI client of yours currently looks like.
I think it differs definitely from client to client.
Of course.
That's one. If I take you back 20, 30, 40 years back, when I started my career, 30 years back, right? An average client's portfolio was largely into real estate and fixed deposits, okay? There was barely a fraction of money into stocks or something. Then started mutual funds, and we've seen the numbers in mutual funds. From 2015, we were sitting on a 15 trillion number, and today we're at 80 trillion. Okay, so the markets have swelled up in a very significant way. So today, if you ask me, I think there's a good split between properties, real estate. When I say real estate, it's not residential, definitely not residential. It's largely commercial. They have commercial properties, and largely money into mutual funds. There's a bit of alternates, definitely yes. There's a bit of global exposure to global equities, your global assets, your global properties, a little bit of exposure on gold. Okay, so it's a very properly diversified portfolio, and that's what they believe in. If you ask me, they stick to the boring basics.
Yeah.
They don't want to venture. Of course, there's a lot of money now going into startups as well. They back a lot of startups because that's, again, a fraction of money. When I'm saying on 100 rupees, if they have 100 rupees, I mean, 10% would definitely be in cash, because at any given point of time, there's an opportunity. They are opportunistic, and their relationship with money is not emotional. It's very practical. They don't take emotional decisions, definitely not. Okay. And so cash is there always, because that can be deployed at various at levels of when they see opportunities in the way in the market or real estate or in equities. But largely, I think it's funds, it's real estate, it's a bit of startups, it's a bit of alternates, it's a bit of global exposure.
Yeah.
So it's a mixed bag of everything.
What's the maximum concentration in? You would say commercial real estate and mutual funds max?
So I think mutual funds and that play a huge part of the portfolio.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.